New tax brackets and rules in 2024 you need to know. What's up, everyone? Welcome back to my channel. Big changes are coming from the IRS for the 2024 tax season that you need to know about. The tax brackets and other rules have been adjusted to account for inflation. In this video, I'll give you a quick overview of the new brackets, so you can understand how much income will be taxed at each rate. This helps you optimize your tax planning and financial decisions for 2024 and beyond. I'll also discuss some of the other inflation adjustments by the IRS, including changes to the standard deduction, IRA contribution limits, income phase-outs, and more. These 2024 brackets and rules will help you legally minimize your taxes and avoid costly mistakes, so make sure to stick around for the full breakdown. The federal income tax brackets and rates for 2024 will remain largely unchanged from 2023. The 7 tax brackets are still 10%, 12%, 22%, 24%, 32%, 35%, and 37%. However, the IRS has adjusted the income thresholds for each bracket to account for inflation. For example, the top 37% rate will now apply to single filers with incomes over $578,125, up from $539,900 in 2023. The standard deduction has also been increased due to inflation adjustments. For single filers, the standard deduction rises to $14,600 in 2024, up from $13,850 in 2023. For married couples filing jointly, it is now $29,200, increased from $27,700. The standard deduction is crucial in determining taxable income, and the adjustment seeks to account for inflation and rising living costs. The significance of these changes lies in their impact on individuals' purchasing power and overall economic conditions. As inflation rises, adjustments to tax brackets and standard deductions become essential for maintaining fairness and accuracy in the tax system. By keeping pace with inflation, the tax code aims to ensure that individuals are not inadvertently pushed into higher tax brackets due to the eroding value of currency. Understanding these adjustments is vital for individuals and businesses in tax planning, financial decision-making, and compliance with the latest IRS regulations. The changes in tax brackets and standard deductions directly influence the tax liability of individuals, affecting take-home pay and disposable income. As economic conditions evolve, these adjustments help strike a balance in the tax system, considering the changing cost of living and the economy's overall health. The 2024 tax brackets and rules, while mirroring the structure of 2023, incorporate necessary adjustments to account for inflation. These changes to the tax brackets and standard deductions can impact an individual's net take-home pay and total tax liability. Those who qualify for lower tax rates due to bracket adjustments may see an increase in their take-home pay. The higher standard deduction also means taxpayers can shield more income from taxes, which may result in greater tax savings for some filers. In the tax year 2024, small businesses and their owners will encounter several key inflation-adjusted tax parameters that can significantly impact their financial strategies. One notable change is the maximum self-employment (SE) tax rate increase from $160,200 in 2023 to $166,800 in 2024. This rate is 15.3% for the first $166,800 net SE income. This adjustment directly affects the tax liability of small business owners, emphasizing the importance of understanding and planning for these changes in their financial management. Another crucial aspect is the potential write-off limits for qualified asset additions. Small businesses can write off up to $1,220,000 of qualified asset additions in the first year, a notable increase from the previous limit of $1,160,000 in 2023. This change allows businesses to deduct a significant amount of qualified asset additions in the initial year, impacting both their tax liability and cash flow. Small businesses should carefully evaluate asset acquisition strategies to exploit these enhanced write-off limits. Furthermore, pass-through entities such as sole proprietorships, LLCs, partnerships, and S corporations will continue to pass their net ordinary income to the owners. These owners will then be subject to individual federal income tax rates on that income. Understanding the implications of these pass-through structures is crucial for small businesses in choosing the most tax-efficient organizational form. The phase-out thresholds for these tax parameters also play a critical role. Small businesses should know any income thresholds beyond which certain benefits or deductions may be reduced or phased out. Staying within these thresholds is essential for optimizing tax strategies and ensuring maximum benefit from available deductions. In light of these changes, small businesses and their owners must stay informed to optimize their tax strategies. This includes regularly reviewing and adjusting financial plans to accommodate the evolving tax landscape. Compliance with the latest IRS regulations is paramount to avoiding penalties and ensuring businesses take full advantage of available deductions. The adjustments in key tax parameters for 2024 will directly impact the tax planning and financial management of small businesses and their owners. Staying informed about these changes is crucial for maximizing tax savings, planning for tax liabilities, and making well-informed financial decisions that contribute to the overall success and sustainability of the business. Staying abreast of these changes is imperative, as it empowers individuals to optimize their tax strategies, ensure compliance with the latest IRS regulations, and make informed financial decisions. Small businesses, in particular, need to be mindful of several key inflation-adjusted tax parameters for the upcoming tax year. The maximum self-employment tax rate is 15.3% for the first $166,800 net self-employment income, reflecting an increase from the 2023 threshold of $160,200. Moreover, small businesses can potentially capitalize on a higher write-off limit of up to $1,220,000 for qualified asset additions in the first year, as opposed to the $1,160,000 limit in 2023. Pass-through entities, including sole proprietorships, LLCs, partnerships, and S-corporations, will continue to channel net ordinary income to owners, subjecting them to individual federal income tax rates. These changes carry significant implications for small businesses. The augmented write-off limits for qualified asset additions allow businesses to deduct a substantial amount in the initial year, influencing their tax liability and cash flow. The increase in the maximum self-employment tax rate and the threshold for net self-employment income further accentuate the need for small business owners to be vigilant in planning for the upcoming tax year. Navigating the intricacies of tax planning for small businesses in the upcoming tax year is a task that underscores the importance of consulting tax professionals and utilizing available resources. The potential write-off limits for qualified asset additions and the phase-out thresholds are critical considerations for small businesses. These changes present an opportunity for businesses to potentially deduct a significant amount of qualified asset additions in the first year, impacting their tax liability and cash flow. The increase in the maximum self-employment tax rate and the threshold for net self-employment income further adds to the complexity of tax planning for small business owners. In light of these changes, it becomes essential for small businesses and their owners to seek the guidance of tax professionals. Consulting with experts in the field ensures that businesses are well informed about the nuances of the updated tax parameters, allowing them to optimize their tax strategies. Staying informed about these changes is a matter of compliance and a strategic imperative for small businesses. By leveraging tax professionals' expertise, businesses can confidently navigate the evolving tax landscape, ensuring compliance with the latest IRS regulations and making informed financial decisions. Tax professionals can provide invaluable insights into how these changes impact a business's tax liability and offer tailored strategies to maximize tax savings. The significance of staying informed about these adjustments cannot be overstated. Small businesses that proactively engage with tax professionals can maximize tax savings and plan effectively for their tax liabilities. Moreover, this proactive approach empowers businesses to make well-informed financial decisions, aligning their strategies with the ever-changing tax environment. There you have it, folks. The need-to-know details on the IRS tax bracket and rule adjustments for 2024. I hope you found this breakdown helpful for planning your taxes and financial situation next year. As you can see, while the tax rates haven't changed, the income thresholds have been raised across all 7 brackets to account for inflation. So see where your income lands based on the new cutoffs. And don't forget, the higher standard deduction means more tax savings for some without itemizing. If you gained useful tips from this video, like and subscribe to stay updated on the latest tax info. Also, let me know in the comments what other money topics you'd like me to cover in the future. Learning savvy financial moves helps us keep more hard-earned cash in our pockets. All right, catch you next time, and keep that money-making grind going.